Good morning, everyone, and welcome to the 24th episode of the Capitally Insight series of webinars. I'm delighted to share that today we are completing 2 years of our monthly webinars. We've been conducting these regularly on a variety of subjects since we first began in January of 2021. And the topic for today's discussion is macroeconomic outlook. Well, 2022 has been a roller coaster for the world economy and global markets as events unfolded one after the other, and the news flow kept everybody on the edge of their seats. We spent the year coming out of COVID and jumping into the mayhem created by Russia's attack on Ukraine. Starting with energy, the supply side disruption actually became disruptive for the entire world economy as inflation jumped manifold in the developed world to a 40-year high. The initial policy reaction by these global central banks was slow to acknowledge the stickiness and the extent of the demon of inflation. And as Fed played catch up, resulting in a big correction, both in the equity and the fixed income markets globally, China's zero COVID policy and tough action on its industry roiled the markets further. The fallout also extended to tightness in labor markets and never seen weakness in major global currencies, plunging several large developed economies into an unprecedented crisis. So amidst the turmoil caused by global disequilibrium, India has relatively been an oasis of tranquility and has been resilient both on account of its conservative and quick policy response and the prudent reforms undertaken over the last few years to formalize the economy and focus on making the country self-reliant. However, today, as we speak, while we are concerned about the upcoming wave of global recession, there have been a couple of significant developments which shall set the tone for the macroeconomic outlook for 2023. First is the news of China easing its zero COVID policy, and the second is a surprisingly sharp fall in the crude prices, even as Europe's price caps on Russian oil come into effect. So to deep dive into the various macroeconomic influences and how they are going to shape economic trajectory going forward and what it means for fixed income investors, we have with us today Suyash Chaudhary, Head Fixed Income at IDFC Mutual Fund. Suyash has over 2 decades of experience managing fixed income investments. He is one of the most reputed and accoladed debt fund managers who is known to have a tremendous grip on the interplay of macroeconomic variables and fixed income markets. His strength lies in his ability to anticipate interest rate movements and identify attractive investment opportunities across market segments. So thanks a lot, Suyash, for joining us today. Welcome.
Thank you so much, Rajul. Happy to be here, and thank you for inviting me for this webinar.
Not at all. It's our pleasure. So now the floor is all yours. Please share your thoughts and insights with us.
Thank you. And so, you have given a great summary of what went on in the world over the last couple of years and, some drivers on what to look for in the future. But let me just, try and elaborate upon that a little bit.
Sure.
I think, it's very helpful to have a bit of context to what is going on today. So let's dial back to, for example, the period just prior to COVID breaking out, when most of developed market, in fact, was fretting that they have too low inflation. So if you'll recall, and it almost seems like a too distant memory right now, but Japan had been struggling to generate inflation for almost decades.
Right.
Europe seemed to be heading in that direction because the European Central Bank was consistently undershooting on inflation targets for a number of years. And the US was beginning to worry that, they themselves were not able to meet the 2% inflation target across cycles. In fact, this was the context under which the US Federal Reserve unveiled the average inflation targeting framework, which was in a sense, it contained 2 things. One is that they would allow inflation to deliberately overshoot the 2% target for a period of time to make up for previous undershoots. so that average inflation was 2% over cycles. And second, that instead of anticipating inflation, they will react to it. Right? And this was all built from a standpoint that even with a very tight labor market where unemployment rate was in the vicinity of 3.5%, they were not able to generate enough inflation to sustainably hit 2%. So this was the backdrop going into COVID. And we were also fresh out of a global manufacturing recession, which was accentuating worries around lower inflation and low growth. And then COVID struck. Now, one of the things that we know, especially with the benefit of hindsight, is that from a macroeconomic standpoint, most policymakers, I would say even market participants, misdiagnose the economic impact of COVID. So for the well-to-do companies and individuals, it was really a stoppage of time. So your purchasing power as an individual, if you were well-to-do to begin with, if you had a steady job or a large business, your purchasing power was largely intact. Your income continued to roll in at a location, and parts of your discretionary consumption basket fell off because you could not consume that. So a lot of your services like travel oriented, hospitality oriented, etc., you could not consume, but you were accumulating purchasing power while not consuming that. Similarly, if you were a large firm, you were able to actually suspend manufacturing for a while, push back some of the upstream costs that would normally accrue to you, and basically survive that period, keeping your financial viability intact. However, if you were not so well-to-do, if you lived by variable means, not a steady job, or if you were a small company, this was much more than a stoppage of time. So it actually led to destruction of your purchasing power because you lost your job, or destruction of your ability to survive if you were a small company because you could not live on continuous accretion to the top line. So therefore, especially with the benefit of hindsight, the appropriate economic measures should have broadly addressed the lower half, economically speaking, of economic agents, whereas the upper half were more than capable of taking care of themselves. Also, the stoppage of production and consumption basically exaggerated the amount of downturn that was actually happening. Because remember, a lot of economic data collapse happened because people simply could not produce and consume. But the upper half of what we now call the K-shape had all their purchasing and consumption powers intact. And therefore, the amount of stimulus that you should have rolled out, especially with the benefit of hindsight, should have largely catered to the lower arm of this K. Now, this is the context in which one must evaluate both what developed markets did and what developing markets like India did in response to the COVID crisis, because that is what has led us to where we are today, what has gone on over the last 1 year, and what most likely is going to happen in the next year. So developed markets, and let's focus more on the US because that's the most important developed market that we typically think about, really laid out all sorts of stimulus, the big guns, so to speak, partly because of misdiagnosis of the problem, and partly because they can, because they print the US dollar, and therefore there is no theoretical constraint to how much money that they can spend, because they can always print and spend, and the US dollar is needed by every other
currency of the world.
Absolutely. So to put some numbers in context, the excess fiscal stimulus that the US administered over this 2-year period amounted to something like 20% of their GDP. This is over and above the usual run rate of fiscal deficit of around 5% of GDP that they were doing, and broken over 2 years. Not just that, a significant portion of stimulus in the US was through direct cash transfers to people. So you were not working for that period, but many people had their purchasing power intact. and you loaded that with even more purchasing power through cash transfers. Now, don't get me wrong, there were quite a few people who genuinely needed that transfer, but very little nuance was used in that phase because, like I said, partly in hindsight, misdiagnosis of the problem, and partly because you could afford to spend.
Mm-hmm.
Similarly, the US Federal Reserve, who was already struggling with generating adequate inflation, like we just spoke about, really went into town with the amount of balance sheet expansion that they did. So, in a very short order, the US Federal Reserve doubled their balance sheet. And the original balance sheet size was also, already exceedingly large because, bear in mind, quantitative easing has been with us, ever since the global financial crisis on and off basis. So the combined stimulus was huge, and what it did is, it started to create purchasing power or domestic demand much in excess of the supply that was available. The supply in turn was, held down partly because of supply chain disruptions, which were again partly as a result of COVID and the starts and stops that happened around the world. And then early in 2022, this got accentuated through the Russia-Ukraine war that you referred to.
Mm-hmm.
However, the core of the problem was neither the supply chain disruption nor the commodity inflation post the war, because if these were the only problems, developed market central banks would have treated this as a supply side shock to inflation and would have accordingly formulated policy. Bear in mind that a supply side shock, unless it translates into second order effects via perpetual or persistent rise in prices, central banks typically don't act very harshly to. However, the problem, like you referred to, was excess demand and tight labor market, which one-to-one correlates with the massive amount of stimulus that was given in many of these geographies, which in turn was partly a misdiagnosis of the problem and partly because you could afford to spend that because you were printing one of the reserve currencies of the world. Now, in a somewhat ironical way, the way this has come to roost home in some sense is not that their currencies have depreciated or devalued, but because local inflation has risen to levels that they have not seen in 40 years. Right? So this is basically the last 2 years running up to, let's say, late 2021. Now look at India also in this context. So India right away, I think, understood that we are an emerging market, and therefore we can only afford to spend that much amount of money. And I remember even in 2020 and 2021, some statements that used to come out from government saying that, if there is no production happening, if people are not able to move, what will happen if we give that excess stimulus? So in some sense, I think Indian policy makers were wise enough to already diagnose the impact that, the K-shaped impact that would happen in the period of COVID. Also, probably that decision was built on the fact that as an emerging market, you could only expand your fiscal deficit that much. Whatever be the reasons, if you see what happened in India over 2020 and 2021, not only was the amount of excess fiscal stimulus very much more measured. By our reckoning, the excess fiscal stimulus in India was of the order of 5 to 6% of GDP. Bear in mind also that although the headlines deficit was looking much higher in 2020 and 2021, the government also used that to clean up their balance sheet quite a bit. For example, food subsidy was largely funded via the Food Corporation of India right up till 2020-2021, and therefore a large part of it wasn't shown as fiscal deficit.
It was outside the fiscal deficit.
Absolutely. So all of that was brought into the fiscal deficit. Similarly, a lot of the capex program of the government used to be run through public sector enterprises. You will recall that NHAI was taking on a lot of debt to finance the highway expansion program of the government. That too was brought into the union budget. So adjusted for this cleanup, we don't reckon that the excess fiscal stimulus in India was more than 5 to 6% of GDP. Also, a large part of it was dedicated to the lower arm of this scale. right? So look at, the food subsidy program and the extension of it. Look at, a lot of others. So the credit guarantee program rolled out for the SME, MSME sector, etc. So the diagnosis in India turned out to be quite accurate. If you turn to RBI, against 100% expansion in the Fed's balance sheet, RBI's balance sheet expansion cumulatively was less than 40%. Not just that, starting late last year, which is somewhere around October 2021, the RBI had already started to shrink their balance sheet. While the US Federal Reserve was still expanding balance sheet early this year, when it was quite clear that inflation and the hot housing market were becoming a problem. I went into all this detail to set the backdrop, because this is a question that today gets asked quite a bit, that if the Fed has to hike till 5 or 5.25, how can the RBI stop at 6.5? Right? And this entire background is basically to support the point that since the size of the excess overhang in India is next to nothing, the amount of cleanup that you have to do in the cycle is also very modest. And therefore, you can very well have a point in time where the Fed peaks at 5 and the RBI peaks around 6.25 to 6.5. Although later on in the cycle, this gap will widen. This I will address shortly. Now, with this backdrop in mind, turn to this year. See, the number one problem for global macros, fixed income markets, asset markets in general this year has been to try and decipher where the federal funds rate, right? And when we started the year, absolutely. So when we started the year, we had a good sense that inflation is a worry. The Fed had a good sense the inflation is a worry, but most people thought that if the long-term neutral Fed funds rate is around 2.25 to 2.5, probably you will have to hike till 3 or 3.5, right? So although most people, including central bankers, were aware we have a problem, we did not realize the magnitude of the problem. And therefore, most of the year has been trying to hunt the top on where the rate cycle in the US peaks. Concurrently, and as an outcome of this, you have had a one-way rise in the US dollar, which has basically been the big issue that emerging markets like India have had to grapple with. So as you kept hiking your Fed funds rate expectation, in sympathy, the US dollar kept on increasing and increasing because of the divergence of monetary policy over there. The other thing that happened, which was, very, very hostile for commodity importers like India, is the Russia-Ukraine issue, which basically led to almost 2 quarters where commodity prices just went through the roof, right? So if you look at from India's standpoint, you were simultaneously dealing with 2 shocks. One shock because of the rise of the US dollar, and alongside that, this massive rise in commodity prices, chiefly and most importantly oil, which went all the way till $120 to $140 band for a period of time. In some sense, over this period, the balancer has been China. And this is an important point that I think we need to keep in mind, because I think, like you referred to in your opening remarks, next year, it is Chinese reopening and growth that one looks forward to, while the rest of the world slows. Just like this year, or since late last year, the rest of the world was growing quite significantly, whereas China was slowing. So the Chinese aspect is quite important to this story, because over the last couple of years, China has been trying to clean up their real estate and the new age tech sector, partly owing to that and partly owing to the COVID disruptions. They have actually seen a very significant slowdown in growth, because as you know, real estate through direct and indirect linkages constitutes a very, very large part of any economy, including the Chinese economy. So China has slowed from somewhere around 5 or 6% growth rate to what people expect somewhere around 3% this year. Just as a large part of the developed market was slowly eating through the excess stimulus that was provided. Now, suppose this year China was also growing at 6%. then you probably would not have seen a $140 peak on oil. It would have gone much higher. Right. So in some sense, China played an auto balancer for the excess stimulus that was provided in the developed world. Now coming back to the story for this year. So emerging markets like India, for most of, let's say, the period ending September, so for the most part of April to September, we're struggling with two issues. One is the rise of the US dollar, and two is the very large, massive shock to commodity prices, which in turn bloated our current account deficits. And for a while there, there was a bit of a short-term concern with respect to local macros, while keeping in mind the view that the overall macros were looking quite fine, but just for a short period of time there was a bit of worry in markets. However, now if you look at how things are shaping up as we speak, so the sense about the Fed or the terminal Fed funds rate has continued to go up. So from where you were expecting it around 3/4, 3/2, all the way till August, September, today you are expecting it closer to 5%. Right? So most people in the market and market pricing is for the US Federal Reserve to hike all the way till 5%. However, if you see the dollar index, it stopped moving up after September. So September marked the peak in the dollar index, and since then it has fallen appreciably, even as rate hike expectations in the US has continued to move up. And that's an important difference that we have benefited from over the last 2 or 3 months. Partly it's also reflected in some bit of our forex reserves getting recouped again. So partly it's valuation effect as the dollar index weakens, so naturally your forex reserve starts to look better. But partly it's also that RBI has been able to buy back some forex. But as a combination of the two, roughly we have added around $35 billion from the low on our forex reserves. The other aspect that is happening over the last couple of months is now markets globally are genuinely more worried about the growth slowdown. So, and this is something which is a shift in pricing after September, October. So now two things are happening, which give you a very clear sense about the extent of worry that markets have on growth slowdown. The one is the so-called yield curve inversion in the US, right? So what I mean by that, essentially, I'll explain. So one way we look at yield curve inversion is the yield on the 10-year minus the yield on the 2-year. And that in the US is something like minus 80 basis points right now, which, if memory serves me correctly, is the most inverted since the early 1980s.
So just to elaborate on your point, I mean, higher the tenor, usually interest rate should be higher for a longer tenor paper compared to shorter tenor paper.
Yes. So let me just spend a minute more to explain what we mean by this yield curve inversion. So typically the 2-year bond yield is a proxy for the trajectory of interest rates in this cycle, right? So you expect Fed to peak at around 5%, and then markets expect a bit of rate cuts in 2023. So on average, where markets expect over 2 years you will earn is what the 2-year yield denotes. The 10-year is a better proxy of what you think over long tenure, on average, the Fed funds rate is likely to be, right? So when the 2-year is something like 4.30 and the 10-year is something like 3.5, what the market essentially is saying is that we believe that what the Fed is saying they will follow through on, and they will actually hike all the way till 5%. However, that will be so far off from where the long-term neutral rate is that we are not convinced it won't cause any accidents. Right? So basically the extent of inversion tells you how far you are from in what the market think is the long-term neutral rate versus the top in this cycle, right? The other thing that has also been happening over the last couple of months is, and again, something that you referred to, I think, at the beginning, is the considerable fall in oil prices and commodities in general that we are witnessing. Again, a sign that people are worried about, this aggressive amount of rate hikes finally breaking economic growth. And then there are enough signs from around the world. Let me, just spend a couple of minutes on a few signs that we are tracking. See, we spoke about the massive amount of fiscal transfer, cash transfers that happened in the US to some extent in other places from the government to consumer balance sheets. Now, in the US, people assess that something like $2.5 trillion worth of savings was created because of these cash transfers, which have protected the consumer significantly this year in the face of economic slowdown, in the face of high inflation. But generally, people estimate that roughly around 1.5 trillion of this 2.5 trillion is available. The rest has been spent, right? But what this has done is that 3 months back, you would have thought that the pace of global economic slowdown will be quite substantial. However, developed markets have done better than what you would have expected because of this very large fiscal transfer in the US, and because, for example, in Europe, this year, a lot of fiscal stimulus was given to protect consumers from the high cost of energy. Many people estimate almost 2 percentage points of GDP has been spent in some form or fashion to protect consumers from high energy prices. As a result of all of this, most of the services sector in the developed world is still doing very well. However, the goods sector is beginning to soften. The housing sector is softening quite substantially, but the sum and substance of all of this, it's not reflecting as much in the labor market, and the Fed needs the labor market to soften for wages to soften, which will give them conclusive comfort that inflation is going to fall off, right? So the way Fed is looking at inflation is goods inflation is beginning to fall. Services, as far as other services are concerned, let's say housing related, etc., things are fine because incrementally rents are beginning to fall. But non-rental services, which are very directly linked to wage growth in the system, that is still very sticky. Right? But there are concrete signs that the goods economy is beginning to soften. So, for example, there are these surveys that happen for manufacturing and services industries, which we call PMIs. So the global PMIs in the last reading came sub 50, which basically denotes contraction. If you look at a lot of economies in the Asia-Pac region, so look at a lot of export-oriented Asian economies, they are now beginning to really suffer on their new orders, export orders, etc. China, which has begun reopening, is probably now facing a surge of fresh COVID infection. So all the policy loosening that they have undertaken, including in real estate and the way they approach COVID, in the near term is not taking too much effect because of a potential fresh rise in COVID, which a lot of people are worried about. So the sum and substance of what I'm saying is that over the last couple of months, for a variety of reasons, some of which that I laid out, even though your expectation that the Fed hikes to 5% is intact, dollar index has weakened and commodity prices have fallen. And those, just from a selfish macroeconomic standpoint for India, are beneficial.
Good things, yeah.
So probably the worst of the storm has been passed, right? Now with this context, if you look towards the future, and I'll turn to India and I'll discuss India holistically, and from there I'll move to the bond market. But let me just finish some final thoughts on global macro. So this year was about finding the top one, where central banks in the developed markets will hike to. Most of next year is going to be how long will they keep it there before they start to cut. And already there is a conflict between central bank commentary and markets today. So the market pricing is that by late next year, the US Federal Reserve will start to cut rates. The Fed, on the other hand, is very clear that the experience from the 1980s suggests that if you are premature in declaring victory on inflation, it can come back with a vengeance. And therefore, their current intention is to keep rates where they are for longer. And I think, neither party can claim victory right now in their view, because each one of these from here on will be very much governed by how data is progressing. Because
so Yash, to add to that, from a Fed perspective, they have to anchor the expectations.
That's right.
If they also just toe the line of what market is saying, then you're done away with that, right?
Absolutely, absolutely. So
Even
that's
if
actually
at the back of their mind, the thing is that they may ease by next year. Right now,
yes,
they can't say that.
absolutely. That's a very, very important point that you made, because the Fed is effectively tightening through the market expectation channel.
Yeah.
And the more hawkish they speak, the more constrained financial conditions are, and the more they do their job for the Fed. So that's absolutely right, because at some juncture, if they think enough has been done, they can pivot quickly and loosen market financial conditions and thereby start the easing process. But till now, they see no signs that they should prematurely commit to anything like that. So that's absolutely exactly what I think they are doing. So, this is the friction we will see over the next 12 months. Importantly, and from a market interest rate standpoint, because remember, markets are forward looking in nature and they work on change in expectations, not actually the point of a rate hike or a rate cut. So, we hear a lot from investors. For example, should we wait for the next RBI hike or should we wait for the next Fed hike? Actually, that's not the relevant point. The point is versus what markets are expecting, will that event surprise positively, negatively, or not surprise at all? And that is all that you need to care about. So, for example, in the last RBI policy, you found yields did not move much at all because it was largely on expected lines, although there was, some differences. But it's really the expectation that needs to align to what the central bank is about to do. And one can potentially hypothesize that. So, take the case of US, take Europe, take Australia, take New Zealand, take a lot of developed markets. It's unlikely that what markets are pricing now, the central bank is going to outdo that. Right, and which is one of the reasons why yields are beginning to stabilize, even at the front, etc. in the US are beginning to stabilize, because it's unlikely that the central bank will positively or negatively surprise markets from here on. And so everyone from here on is no longer on a pre-committed path, but are going to be data dependent. So the Fed expects to hike till 475.5. The market is pricing that in. If it has to hike more, data needs to suggest that it's no longer on a pre-committed path. And that's exactly.
But the impact in the growth will also come with a lag. So, I mean, they need to get it right.
Absolutely. Which is the worry about next year, that the amount of tightening you have done in 1 year is unprecedented.
Yes.
So it's never happened that you have executed 400 basis points of rate hikes in 1 year if you are the US Fed. And therefore, we all know about the lagged impact of monetary policy tightening. It is possible that 6-7 months down the line, we feel the cumulative impact of all this tightening that has happened. And bear in mind, for example, in the US, even fiscal policy is now very neutral. Now the House and Senate being divided between Republicans and Democrats, it's very unlikely that you will see any sort of a meaningful fiscal stimulus in the US as well. So the combined effect of Fed tightening and fiscal normalizing, you will probably feel over the next year. And that's the other thing which you have to look out for next year, that economic data will keep driving how long central banks are going to hold where they are and how sharply will they be able to cut rates post that. So there is a point of view globally that there'll be a hard landing, because the cumulative effect of this 400-500 basis points, it's very difficult to model. Right? There's another point of view which says no, it won't be that hard and Fed will have to keep it higher for longer. So these two parties will basically be warring over the first half of 2023. My sense is by the second half of 2023, the picture will be very clear which camp is winning. Right? Now, if you turn to India, see, so basis the context that I said before on India's total fiscal and monetary stimulus versus the West, and where fiscal stimulus was pointed in India, we always believed India doesn't need to do too much in the rate hike cycle, right? However, two things happened. One, the conflict happened, which led to a supply side shock to commodities, but it was a shock that lasted for long enough that the central bank had no choice but to start to think about the second order effects. And second, what you thought as terminal rate for the US turned out to be 200 basis point higher. So our initial thought earlier in this year would have been that the repo in India will peak somewhere around 5.5-ish. However, we have been forced to revise that for the two reasons that I mentioned. And we now think that either the last rate hike is done or there is one more pending for February. We are unable to make up our mind for the last 25 basis point, but we are comfortable with the idea that the repo rate in India is peaking in this cycle between 6/4 to 6/2. So we have already achieved 6/4. We may be there at 6/2. That is one more rate hike that may or may not come in February. Importantly, market expectation is very much for 6/2. So again, if you think back to what I said, markets respond to change in expectations and not necessarily the fact of the rate hike. So the market expectation is very much of 6/2. And secondly, basis the commentary we saw in the December policy, although the bias for RBI is still to control core inflation, which is actually a new commentary that they are putting on the table, that we are now worried about persistence of core inflation. But there is also enough in the commentary that suggests from here on they are very data dependent. Our own sense is that, see, India has two very large tailwinds to growth which are manifesting today. One is, if you recall, we have struggled with a very long period of balance sheet cleanup in India, where courtesy a credit misallocation cycle that happened, let's say between 2008 to roughly 2011-12, bank balance sheets on the one side and corporate balance sheets on the other were completely suffering. I make a very general point. There were obviously very good balance sheets there as well, but from a top-down standpoint, a lot of bad assets were created in that cycle. As we were beginning to get a grip of that, you had the whole NBFC crisis that exploded in India. So for a very, very long period of time, we have been suffering some sort of balance sheet issues or the other at a very large scale. Finally, that is all done. Right. So over the last 1.5 to 2 years, corporates have finished the cleanup process. Banks have provided for and finished the cleanup process, and most NBFCs are now following robust business models. Obviously, there'll be exceptions in every subsector. So that's a massive tailwind that has emerged for India. That for the first time in a very long time, banks have, on average, on aggregate, capacity to lend, and many corporates have capacity to borrow. And the second aspect that we dwell on quite in detail is that India doesn't have any overhang of excess fiscal and monetary stimulus to clean up. So you are not taking a sledgehammer approach to tamp growth down, and therefore that is also working in our defense. Having said that, you can't be immune to the global cycle. So you can't have a place where a significant part of the developed market is actually going into recession, where global goods trade, which is growing at 3.5%, will probably grow at 1% next year, which is what the WTO seems to be indicating, and India continues to accelerate. That won't happen. So our sense is, led by the export, so the strength of the domestic balance sheets is well recognized. India will also begin to slow, although relatively it will do much better than most of the rest of the world. So we will probably print somewhere around 6.5 to 7 this year. Our sense is we will be in the 5s next financial year. Now, where in the 5s, we don't know. Could be early 5s or late 5s. But the important point is that sequentially, India will also deaccelerate, led by the export sector, something of which is already beginning to start. And this is something where we think eventually the RBI will have to say that, enough tightening for this cycle. So note, currently they are very, very optimistic about the way growth has picked up, as you should be, because concurrent indicators for growth are extremely strong. But if you look 6 months down the line, a lot of the export-led sector slowdown would probably have started to play into internal growth dynamics, although I reaffirm that relative India story will still look much better than the rest of the world. And which is why we also think that probably 6 quarters is enough, if not a last rate hike is pending. However, the difference could be that the Fed peaks at 5 and RBI peaks at, let's say, 6/4 to 6.5. The Fed is very far from what is the long-term neutral in US, but the RBI is not very far from what is the long-term neutral in India, which more simply means that even when the Fed starts to cut, let's say late 23 or early 24 or whenever, the room to cut for RBI will be that much lesser. So therefore, cyclically, this will be the lowest point, the lowest difference between US Fed funds rate and RBI. And this will widen over the course of the next couple of years by the Fed cutting more than what the RBI can afford to cut.
Right.
Finally, let me spend 5 minutes on the bond market. So, we have this concept of the yield curve in the bond market, which is nothing but the price of money at various tenures. So the 1 year, 2 year, 5 year, 10 year, 15 year. Typically, when we think about the bond market, we think about the price of money at the overnight point. Let's say at the 1 year point, the 5 year point, and the 10 year point, and longer than 10 years. So that helps you construct what the yield curve looks like. Let's stick to the government bond yield curve. So today, you have a repo rate which is at 6/4. The overnight rate fluctuates between 6 and 6/4. The 1 year treasury bill, which is the price of money for 1 year for the government of India, is roughly around 6.85 to 6.9%. The 5 year government bond yield is roughly around 7.15 to 7.2%. And the 10 year government bond yield is roughly around 7.3 to 7.35%. Now, the first thing you notice is that the overnight at 690 to the 5 year at 720 to the 10 year at 730, the 5 year to 10 year spread is hardly 10 to 15 basis points. So the 10 year minus 5 year is hardly 10 to 15 basis points. We think it's too low, right? So even though we are constructive on the bond market, because we think we are close to the peak on this cycle, we prefer to express that view via 3 to 5 year government bonds and not beyond that. Because we think in India, the center's fiscal deficit will be slow to consolidate, and annual bond maturities are very large over the next 5 years. So when the government decides to borrow for a year, it is the sum of what portion of fiscal deficit you want to borrow and refinancing the bonds that are maturing. So the gross borrowing that the government is doing this year is roughly slightly in excess of 14 lakh crores. Next year, even assuming that the fiscal deficit to GDP falls from 6.4% this year to 5.8% next year, we are still seeing a gross borrowing program in excess of 14 lakh crores. So when you think about interest rates, don't think of interest rates as just one thing. Right? You have to think about the yield curve and where the risk versus reward looks the best. Now, for me to buy the 10 year and 15 year, I need the gross borrowing program to be smaller than what it is, or the spread between 10 year and 5 year to be higher than where it is. Right? But the spread between 10 year and 5 year is actually quite low. And therefore, we feel just the expression of a view that rate cycle is peaking is much better done through 3 to 5 year government bonds. And that is what we have been overweight in most of our open-ended funds as of last published portfolios. And a lot of the index funds that we are doing are also getting traction around the 5 year point.
So basically the risk return is right now in favor of that segment.
The 3 to 5 year segment,
3 to 5
and
year.
not so much the 10 year and beyond, but that view may change or evolve in the future, which is not the view currently. The other thing, the other aspect of the bond market to keep in mind is, so this was the sovereign curve. Now look at the corporate bond curve. Now, this year, for the first time in many, many years, banks have a problem of excess credit versus deposit. And this has happened after many, many, many years, right? So banks are lending out more as credit than they are garnering as deposits by a reasonably wide margin, referred to as incremental credit to deposit ratio. Now, because of this pressure, bank CD rates have gone up quite substantially. So today, a AAA bank raises 1 year bank CD at anywhere between 7.5 to 7.6%, right? So now this pressure probably continues for the rest of this financial year that ends in March. But our sense is, come the April to September half year, two things will happen. One is economic growth itself will begin to slow down, and credit will move from what is called busy season on credit, which runs between October and March, to what is called lean season on credit, which runs from April to September. And the incremental credit to deposit ratio pressure should automatically start to subside. So for shorter investment horizons, let's say running from 9 to 12 months, we also think it's probably making sense now for investors to start to look at 1.5 year maturity corporate or quality corporate AAA oriented strategies, bearing in mind that over the next 2 to 3 months the pressure remains. So you have to have a 9 to 12 month horizon on that. You have to at least see through most of the April to September half year, right? So bank CDs in the 1 year point, corporate bonds in the 1.5 year AAA point, etc., will soon start to make good sense in our view with a 9 to 12 month horizon. But if you're longer than that horizon, then we think 3 to 5 year government bonds are best placed. So this is basically a summary of what we are thinking. A final point before I close my initial remarks. A lot of questions we get now is that, balance sheets are cleaned up, so why not credit risk funds? The simple point is credit risk fund or credit spreads are reflecting the balance sheet cleanup and then some more. So put another way, credit spreads have shrunk to a degree where even though you recognize that the underlying balance sheet has cleaned up, it's not providing you enough compensation. Now, our sense is that India is moving from a period of surplus liquidity over the last 3 years to now a period of neutral liquidity, and therefore liquidity premium will start to widen. That will put some upward pressure on credit spreads. So in our view, investors who are looking to invest in credit risk sort of strategies should hold their horses and wait for better spreads, even though we recognize that balance sheet cleanup has been happening. I think I'll stop there and I look forward to your questions.
Sure. So Suyash, thanks a lot for that very comprehensive overview of global and Indian macroeconomic factors and the interplay, etc. Usually on these webinars, we get more views on macroeconomics from equity fund managers. So I'm sure everyone in the audience found it very refreshing hearing it from you, your version, which is a little different. We don't talk so much about these other things in other calls. So I had a follow-on question on inflation that, yes, we said that probably next year, somewhere towards the end, Fed may look at, reducing interest rates or cutting interest rates. So historically, someone had shared this data that whenever inflation crosses 10% in any country, historically, it has taken them anywhere from 5 years to 30 years to come back to their, from where they started. So let's say in US, from 10 coming back to 1 or 2 could take slightly longer. So what is your view on that? And if that takes longer, what is the end figure in Fed's mind? Where would it like to go before it starts easing? And if that does not happen, then what happens to growth and markets going forward?
So, that's a very, very interesting question. In answering this, we should always probably look at the sources and drivers of inflation, not so much the concurrent data of inflation, right?
Okay.
Now, we just discussed the backdrop leading to the COVID crisis, which was of extraordinarily low inflation, and the problem was generating more inflation rather than less inflation. If you see today, inflation expectations in the US, traded inflation expectations, or even surveyed inflation expectations, they are not alarmingly high. So if you, for example, look at market traded inflation expectations for the 5 year point, they are, if I recall correctly, in the vicinity of 2.5, 2.7%. So what markets and probably economic agents are basically telling you is that they haven't lost faith in the Fed's ability to bring inflation down, right? Which is very different from the 70s and 80s, where a lot of inflation was showing up in fresh contracts, and therefore it had a life of its own, right? Our sense is that the bulk of the inflation problem that you're seeing today, let's say in the US, has to do with this massive excess saving buffer that I referred to, $2.5 trillion, which probably roughly 1 trillion is now being drawn out, which led to people, staying out of the workforce to some extent, and putting on more discretionary consumption for a period of time as well. Although there are genuine problems, so more people have retired, so size of the labor force, etc., has shrunk.
So what about wages and salaries, which have gone up so much? I mean, normally their wage hikes are just like barely flat or 2%.
So absolutely that, so
would that be more well entrenched going forward? I mean, You
Which is
have a
what
certain
we are
expectation.
not convinced it would be, because if the long-term inflation expectations are still in the 2.5 area and wages currently are growing at 5 to 6%, you would expect that over a period of time, new wage negotiations, etc., will come down. The other point that many people make is the strength of union or unionization in many of these markets is nowhere as it used to be in the 70s and 80s. So I don't think the expectation framework is yet at an alarmingly high level, and this very large action that central banks have put on the table also suggests that it's unlikely that it gets entrenched. However, see, nobody expects inflation to get back to 2% next year, not even the Fed, not the markets. So where to stop hiking? Probably what central banks need to see is concrete signs of disinflation, not the fact that 2% is in sight. When to start cutting, however, will very strongly be predicated on 2% being in line of sight.
Okay.
So probably they hold this 5%. Like I said, most of next year is going to be this debate, right? There'll be one camp who will say that aggressive rate cuts are coming. The other camp will say, no, they'll hold it there for longer, right? Which is unlike this year, which said, somebody said peak is 4, somebody said 5, somebody said 6, right? So the argument changes. But they will look for signs of disinflation to stop hiking, and they will look for clear pathway to 2% to start cutting. In fact, in India also, the debate, in my view, is positioned wrongly. It's not that RBI needs to get to 4% in a hurry. RBI needs to see that 6.5 is going to, let's say, 5 and then going to 4. The pace of disinflation visible will stop them from hiking further, and actual will probably embolden them to cut, which is a separate story. We don't know when that goes. The one additional point one should keep in mind is a lot of economic pain in some sense this year from higher rate hikes got masked because of very high inflation and high nominal growth.
I was coming to that,
So next year, nominal growth rates will fall. In our view is probably India will see something like 16% this year, next year it will show 10%. And that is when the pain of higher nominal rates in a lot of geographies will start to come through. And for a lot of companies.
Right. Yeah, so I mean, right now with a higher nominal GDP growth rate, their debt to GDP ratios, I mean, everything looks good, right? And if that
yes, although to be fair, that will be just 1 year, so it's more the flow rather than the stock that you have to worry about. But optically, a lot of things that look good this year is happening because of very high inflation. Even the 18% credit growth rate that you're seeing today.
Right.
If you adjust for inflation as well as the fact that a lot of other sources of financing dried up, including offshore borrowing and bond market, etc. So the credit growth has picked up, but it's nowhere as spectacular as the headline level seems to suggest.
So where do you think it will settle next year?
Anyone's guess, but I would think a lot lower than this. So even if you were to adjust for inflation and just look at real credit growth, and if you stretch it over the last 2, 3, 4 years, because bear in mind, you had a complete, drying up of this, for 2, 3 years, and then it's picked up. So it's very encouraging. It's picked up, and there is incipient signs that there is some capex-led demand for credit also picking up, but it's nowhere close to what incidentally you can infer from the 18% headline growth rate.
So, okay, coming to the question of growth, I mean, you did say that because there is going to be a recession, we could have lower exports, and that will feed into a lower GDP growth rate for India next year. So what could be some of the structural drivers going forward for the next few years, which will ensure that we come back to, let's say, 6%, which is our long-term target, or which, I mean, everybody says that India is capable of doing and should do, target to do that?
So, one is clearly the balance sheet cleanup, which, one cannot overplay the impact of that, because that has held us down for, a
decade,
7-8 year period. And the second probably is the entire formalization effort, which is now bearing fruits, right? So one could argue that there is some sort of buoyancy in tax collections over and above the higher inflation as well. And that is actually true then, when the lean phase kicks in on nominal growth rate, probably revenue collections will not just sink through the floor, they will have their own level of buoyancy. And third is, the extent of balance sheet cleanup that the government has been able to do, right? So now a lot of the deficit that you're seeing is the actual deficit. In fact, if you look at center plus state plus public sector capex to GDP, that has not moved up as much as the center capex to GDP will show you. Okay. Right, so it's more the cleanup that has happened, alongside a very genuine and sincere thrust from the center to increase their proportion of capex spending.
Yeah, they're front-loaded this year also, and there are elections in 2024, so next year should also be good, at least as far as the government goes.
Yeah, but I don't think the fiscal sensitivity to election is that much. I mean, we saw it in the last.
No, I'm only talking about capex, not fiscal.
No. So capex, I think, is a policy thrust, and that would continue. But remember, and sometimes the effect gets exaggerated because we don't look at state and public sector enterprises also. So when
overall,
you combine the three, and in fact, it's a bit of a concern what states have been doing. So states actually have fallen back to the pre-pandemic fiscal deficit run rate in a very short order. So, the extent of compression of fiscal deficit that states have shown is tremendous. In fact, whole of last financial year versus the planned borrowing program of states, they undershot that by very close to 2 lakh crores. Okay. This year already versus the planned borrowing program, they are undershooting by very close to 2 lakh crores. Right, so states have actually compressed fiscal deficit. I don't fully understand why, but to a very, very significant extent. And therefore, even the total fiscal expansion, if you add what states are doing, etc., it's reasonably more modest than what the headline shows.
And what about the private sector investment? I mean, credit offtake, we don't have like the actual underlying number, but what I think one indication would be that where are capacity utilization levels, and at what level do we see a massive, hunger for setting up capacities again?
I think a necessary condition for that would have to be the world settling down.
See, world settling down, uncertainty reducing.
Absolutely. If you can't get a grip on world growth rate, right? If you can't get a grip on the extent of imported slowdown that we are going to see, it's very hard to think about committing too much capital to this, right? But the ingredients are now all there, right? Balance sheets are cleaned up, formalization is there, policy support is there. You just need the world order to begin to stabilize. Value chain, supply chain reorienting, all of that is there. However, when you are taking such massive haircuts to world growth rate, things need to, kind of give you a bit of a comfort that the runway is there for you to be able to commit that amount of capital. But I sense by H2 of 2023, a lot of those pieces would begin to fall in place, because I think the worst of the global slowdown, or just how bad it can be, you will potentially get a good grip of it in the next 6-7 months.
And do you see any challenges to this scenario, what we are talking about, that things will look better by the second half? What could be the pain points? Or, I mean, unknown is always unknown, but anything which you think could majorly impact the scenario?
If developed market inflation proves to be stickier. See, what we now know for sure, that just as in the period after COVID, they were only thinking about growth, we know that now they are only thinking about inflation. And any pretense that they can enable a soft landing of economies, they have abandoned now. So they are only thinking of inflation. So if for whatever reason the underlying stickiness of inflation in developed markets proves to be more than what we are currently thinking, I don't expect more rate hikes than what we are envisaging. But I probably expect, if the stickiness remains, that in the face of a massive economic slowdown, they will keep rates higher for longer. And that would be enough to continue to weigh on global economic growth. See, the other, one quick point I wanted to make is that you don't have to keep tightening policy. So even in India, if you see, and that's a very important point, that, see, even if RBI does not hike anymore, the fact of the matter is that RBI balance sheet growth has subsided. that money creation has subsided, that liquidity in the system is struggling, and therefore banks will have to continue to transmit these rate hikes into deposit rates and in their turn to lending rates. So even with RBI not moving anymore, the process of tightening will still continue through the system. And to some extent, the same thing would happen elsewhere in the world. You just have to keep it here for longer. And while economic growth is subsiding, you will not provide the stimulus that you historically used to provide. And that would be the additional tightening.
Okay. So do you have some ballpark figure that how much more banks have to hike their deposit rates and lending rates? I mean, how much is the lag in transmission of interest rate hikes?
So in fact, the policy that just went by, the RBI policy, was quite interesting in that way, where the governor explicitly referred to this fact. In fact, the sense we clearly got from this is that, part of the reason that they are squeezing liquidity, not intentionally, but they are allowing liquidity to get squeezed, is that they want banks to transmit better. So if I recall the data that the governor presented, look, our low on effective policy rate was 3.35% in India. Today we are between 6 and 6.25. Market expects it, let's say, to settle roughly at around 6.25. So you would have seen roughly 300 basis points of effective rate hikes. Many banks are halfway there, right? So again, you have to break down the way the loan side is. So a significant portion of floating rate loans are now external benchmark linked, which are repo or treasury bill linked, which the pass through is quite immediate, right? But a significant portion of floating rate loans are MCLR linked, and there your aggregate cost of money matters a bit, or matters the most, not a bit. So your deposit rate transmission has to pick up, and the MCLR part of the floating rate loans will also then start to rise in cost. So we do sense from what the governor said that from here on, RBI is very watchful on banks transmitting these rate hikes, and that doing the residual portion of the tightening that remains, which in turn gives us more confidence that either RBI is done or maximum has another rate hike pending. However, in most such discussions, we forget to take account of what RBI's balance sheet size is doing. And that is where a real story is developing, because liquidity in the system is now progressively, quite constrained. And that in turn will, force better transmission of rate hikes already taken.
So Yash, I'll just ask one last question. So, when we are doing financial planning for clients and, making these plans for the next 30 years, what do you think should be a reasonable rate of return which one can expect from fixed income instruments? And whatever figure we take, then concurrently, what inflation number should one take for these long-term plans?
Rajul, this question I will have to bypass as code of conduct for fund managers. And also, given that it's very hard to peer into the future projections. I can, address it in a different way.
Sure.
We look at the instruments that fixed income today provides, and a very important revolution that is happening in India. I mean, it's global in nature, but it's now finally happening in India, is the rise of the index funds in fixed income. And that, does two things. It basically helps you ride interest rate volatility better for an investment horizon that you have in mind. And second, it is very easy to explain for first-time fixed income investors. However, alongside, one should remember that target maturity funds, index funds, have one drawback, and that is that towards the point of maturity, you are subject to reinvestment risk, because they are reducing maturity formats, right? So suppose when you have 1 year to go, interest rates have crashed, there's not much you can do when that money matures. So our sense is, a robust fixed income allocation should definitely have index products, but should also have some well-selected open-ended funds where you are comfortable with the parameters under which the fund is executed. The other very, very good thing that is happening in the mutual fund industry is this PRC, or potential risk class matrix, because that sets the framework of operation for a fund, and it's relatively easy to communicate. Right? So you select your, the PRC buckets you are comfortable with, you select some index products, and then you have some very, very passive long-term allocation. So we keep getting asked this question, you don't like the 10-year today, but, is 10-year fine, right? And the way we answer that is, look, dynamically speaking, we don't like the 10-year.
Hmm.
But if you're investing for 10 years and you like, the current
Then it's a good
rate of-
rate to be looking at.
which is a sovereign product that is offering that rate, and you are not thinking dynamically, then of course, you should go for it. So for the first time in the evolution of fixed income mutual fund industry in India, you have tools which are very easy to communicate.
Hmm.
Not tools, products,
Products.
and tools that describe products.
Right.
And therefore, it's probably a very good time to build a fixed income asset allocation.
Okay, great. So Yash, that brings us to the end of our session today. Thanks a lot for your invaluable insights and for your time. I'm sure everybody enjoyed today's discussion.
Thank you again,
Any
Raju,
last
and
words we want to say?
absolutely. Thank you for the invitation. I absolutely enjoyed the last hour or so, and look forward to doing this again whenever you deem fit to have us again. So thank you.
Great. We will take you up on that. And I would like to thank everybody out there on your time on a Saturday afternoon. Request you to please fill the feedback form as you exit the webinar. And before we meet again, let me wish all of you, including Suyash, a very Merry Christmas and a very Happy New Year. Thank you. Have a great weekend. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.